anything.
All right. Our next guest is pinpointing the date when triple-digit oil could spark an economic downturn and send yields sharply higher. Julian Emanuel is Evercore ISI Senior Managing Director. Julian, what is that date?
So the work that we did starting in 2022 with the original Ukraine oil spike going back 40 years basically suggests that once you get to a level which we identified this time around between $93 and $98 a barrel, and you stay there for 3 to 4 months, and we're giving the economy the benefit of the doubt, like everyone around the table here is, that gets you to the 4th of July. Think about it. There's a concept here where if you are not celebrating the nation's 250th birthday and you're thinking about triple-digit oil, that's when it starts to bite in terms of the market and the economy, in our view.
So you've got a little bit over a month at this point in order to open up the Strait of Hormuz. I mean, what is your thing? I mean, you're not a political analyst, obviously, but even if the Strait of Hormuz is open, that could still mean triple-digit oil. So an end to the conflict wouldn't override, in terms of sentiment, triple-digit oil? If
you opened up the Strait, you would get the back end of the curve start to moderate, and so you'd look through those first few months, much the way you did in the beginning of all this, until the back months started picking up to a level that we are, pretty uncomfortable with.
Okay, so 4th of July happens. We're celebrating. Tim's got the little sparkle thing.
It's a big flag. It's a big flag. Thank you.
Waving, burgers on the
fireworks at my house too.
That's WTI is still triple-digit. Rates are higher. What does the markets do?
The market's going to come off. It will come off. I mean, and then the other aspect of this, if you go back to March, the end of the world hedging levels we had never seen. We were on here talking about that, which is why you got the degree of the rip that you did. And now you're almost the exact opposite of that, where very few people are hedged. And actually, over the last several weeks, for the options nerds, you've had a situation where the NASDAQ has gone up. At the same time, the NASDAQ VIX has gone up, and that usually means a pullback is in store. And, throw in triple-digit oil.
I think Julian must be a mind reader as well, because I was going to say, does it surprise you that the VIX is sub-18, an environment where Japanese bond market is just melting down? I think we would agree. And over here, it's not that rosy. People just don't feel they need to be hedged right now?
Yeah, I mean, so think of it. Go back to last year, right? And active managers, the public never sold on the way down into the tariff tantrum low. Active managers spent 6 months chasing the tape. The decision was this time, I'm not spending 6 months. I'm going to do it in 6 days or a couple of weeks. And boom, there you go. And that's why you got the momentum you got. And you're not going to spend money on hedges when you're likely still behind the index anyway.
Okay, so let's push you a little bit to, not just call a date, but maybe call. Look, I heard you also on your weekly call last week say, based upon, you talked about the hedges that essentially have not happened or that were used up, and the complete opposite. I heard you calling for a correction. I mean, is that fair?
Yeah.
And what's that number? Are we talking about technically a correction? Are we talking about 10%? What are we talking about?
So, and again, there's another break point before the 4th of July, and it's Memorial Day. All of a sudden, we're going to be remembering.
Also big flags and fireworks at my house.
There we go.
Right, we'll there
we go. And $5 a gallon.
Yeah.
Okay. Now, our view is, again, to your point earlier, Melissa, is that the upside of the K-shape has been relatively immune, but the psychology around that changing and horns getting pulled back in our mind, you could get the kind of correction that you got in March was on the order of 10%.
Yeah.
A bull would say, but Julian, the earnings growth has been there for the S&P 500 and specifically for the AI trade, and the job market is holding up. So why should we really be worried? All this is fine.
And it has, no question about it. Again, long term, we are big proponents of the AI trade, and we think that even if you got this 10% pullback, you could still get a rip to 9,000 if you got through the oil issue. But the oil issue is the sticking point, and the outcome is very, very unknown. And from where we sit is that in the same way, the potential for earnings to drive the market higher like it did in April is the potential for oil to drive the market lower now is underappreciated.